Hi everyone, welcome to Accounting for Managers series. In today's video, we are going to learn about the rules of debit and credit. So in the last few videos, we saw how we can identify the accounts and ascertain the nature of the accounts involved in the transaction. Okay. Once we have identified the accounts that are involved in the transaction as well as their nature, that is whether they are real, nominal or personal, if we are following the traditional approach, or if it is an asset, liability, capital, expense or revenue, if we are following the modern approach. So once we have ascertained it, um, depending upon say a particular transaction, that is I made a sales of so and so rupees, then whatever is happening in the sales account will increase, right? The amount in the sales account will increase. So depending on that, as well as if that sales was done through cash, then we would get the cash in hand because of the sales, then value in sales in the cash account will also increase. So once we identify whether the value in these accounts are increasing or decreasing, the next step is to apply the rules of debit and credit. So in this video we will be learning how we can apply the rules of debit and credit. So first and foremost, before we know how to apply the rule, we need to know what debit is and what credit is. Okay, so in everyday language, when we use debit and credit, we usually use it when we are doing some sort of a banking transaction. If we pull money out of an ATM, then in our bank statement, in our passbook, we will get a debit transaction. The message which we get in our phone is also debit. Your account so and so has been debited by an amount of rupees something through an ATM or whatever, right? Or maybe if you have spent some money on Amazon or Flipkart or somewhere else like that, or any shop, you will get such a message that your account has been debited. Whereas if you put money through some CDM, or you receive money through Google Pay or Paytm or something like that, then the message you get is your account has been credited by something. So that is our layman's what you can say, layman's introduction to debits and credits, right? So in accounting, the debit and credit, when we say debit and credit in accounting, it is a little bit, a tiny bit different. Okay. So in accounting, okay, debit is when some amount of money flows into an asset, okay, or a bank account. Okay. So unlike the example of a debit card, okay, where money is taken out of the account, in accounting we debit an account when money is flowing into, that is, if suppose in a transaction you have an asset account, okay, an account whose nature is of asset category, okay, or a bank account, and the value in that is increasing, then that should be a debit. Okay. So what I would suggest is leave out that what you can say, leave out your bank statements from your mind. Okay, start with a clean slate and try to understand what debit and credit is. Do not mix this with our pre-existing notion of what credit and debit is. That is my sincere request, because for me it took a long time, and multiple people tried to explain to me. I tried to learn it from here and there and everywhere, but the concept was so consuming for me, so complex. It was feeling so complicated to me, just because I was trying to intermix what I was currently gaining, okay, knowledge in terms of what debit and credit is in accounting, with what I already had experience of. Okay, that is a banking account statement. So whatever knowledge I had, I was trying to map it. The new knowledge I was trying to map to my existing knowledge, and that is the main reason why it took me so long. So it should not happen to you guys, whoever is listening to this video. I don't want the same thing happening to you guys. So whatever you know, whatever you think you know about debit and credit in terms of these bank accounts and stuff, leave it aside, keep it aside, just forget it, and start learning fresh what a debit is and what a credit is. So if an account is an asset or a bank account and money is flowing into it, okay, then it is a debit. Okay. But if it is an asset, okay, and money is flowing out, that is it is decreasing, then it is a credit. Okay. So a debit will record an increase in an asset, whereas a credit will record flowing out, that is a decrease in asset. Okay. So debits and credits are usually recorded in monetary units, not usually, they are recorded in monetary units, but those monetary units that may or may not imply actual physical cash coming into your hands. Okay, sometimes it is cash, but sometimes it may be because there's a gain or a loss or some kind of a depreciation, or you're making a sale or something like that. Okay, so whatever, when we say whatever we are recording, debit or credit, that monetary value, say 2000 rupees, we call it as value rather than cash. Okay, so it is, we usually in when we say value. What is the value in debit account, what is the value in credit account, rather than how many rupees in credit account or rupees in debit account, we say value. Okay, so layman's perspective, suppose say, let us look at this transaction from the investor perspective. Okay, from our perspective. So let us say that we are putting in money into the bank or into the business. Okay, then what is happening? The cash which we have, that is our asset. Okay, but it is decreasing, right? I am giving money into the business. So whatever, suppose say in total I had 1 lakh rupees. Okay, 1 lakh rupees, and I am putting in 25,000 into the account. So in effect, 1 lakh rupees for me, it is becoming 75 lakh, 75k, right? 75,000 in my hand. But what is happening? It is going into, say, so for example, let us assume that this is a bank. When this transaction happens, what is happening here? Credit, right? We'll get a message that my account has been credited by 25,000, right? So in effect, what happens over here is cash, which is our asset, is decreasing, and it became a credit transaction. Now, when we take out money from this business or from this bank, okay, previously I had 75k because I already put in 25k. Now I'm getting back this 25k. Okay, what is this transaction? I'll get message that my account has been debited with 25,000, right? Cash is our asset, but it is increasing for us. This is a debit transaction. Okay, so this is how we should think about it when we are looking at it from the investor's perspective. But from the investor's perspective, why are we thinking of cash as our asset? Why is cash the asset? The reason why cash becomes our asset when we are putting it in the bank or giving it to a business is because that business or that bank owes us money now. When we give it 25,000, that bank or that business is liable to pay me back at least that 25,000, right? So I'll get that 25,000 back at some point of time. And that is the reason why it is our asset. So that is from the investor's perspective. Okay. Now let us look at the same transaction, but from the business or the bank's perspective. Okay. So from the business perspective, when we get some money, say 25,000, when I get this money, what is happening? I am liable to pay that person back. Okay, I am liable to pay 25,000 to that person whenever that person asks me for it. So what is happening? Now what is this 25k for the business? It is a liability. Now when a liability increases, then it is a credit transaction. Okay, when a liability increases also, it is a credit transaction. But when that person takes back that 25k, when I finally give him back that 25k, then that liability for me is decreasing. So therefore, a decrease in liability will be debited. Okay, so this is the rule, basic rule. An increase in asset should be debited, whereas a decrease in asset should be credited, and the opposite. An increase in liability will be credited and an decrease in liability will be debited. Okay, so why cash is this 25,000 becomes a liability for the businesses? Because the business is liable to pay the creditor back at some point. Okay, so the same transaction, but from the perspective of the business and from the perspective of the investor. Now you can see whether the investor records this transaction or the business records the transaction, credit and debit, it remains the same, right? But whether it is recorded as a liability or an asset, that is what is changing here. Okay, so what is credited and what is debited, that if you see here, right, this is credit. Even over here, even in the previous slide also, in the previous investor's perspective also, this was credit and this was debit. So that did not change, just that how the business or how from which viewpoint we look that account, whether it is an asset or a liability, that changed. Okay, I hope you understood this. because understanding this is important. So as we said, debits and credits, they indicate where value is flowing into and out of a business, and it should be equal. So how much, so in a particular transaction, if I say if I put in the value of 25,000 for in the debit side, then the credit side of the transaction should also have an equivalent 25,000 itself. Okay, they must balance, they must be same and equal to keep the company's book in balance. So this debit and credit are these two accounting tools actually, and business transactions have to be recorded in these two accounts, that is the debit and credit. Okay, and when we say it is in balance, we what we say is that the debit side is equal to the credit side. It is equal and it matches. That is when we say the transaction is in balance. In balance. Okay, but if it is not equal, then it is a problem. The debit and credit, the financial statement is not in balance, and therefore it becomes a problem. We need to find out why it is not balancing and we need to adjust. So if you remember, preparing the worksheet and adjusting the journal entries, that is when we find that it is not matching. Okay, that what I'm referring to over here is the steps in accounting cycle. So now, as we said in the previous videos on how we can classify the accounts involved in business transactions, we said that we had two approaches, right? The traditional approach and the modern approach. Traditional approach was the real, nominal, personal, and modern approach was the asset, liability, revenue, expense, and capital, right? So how do we apply this rules of debit and credit on those accounts? Okay, so how do we apply these rules? So it is very important, or what you can say, the lifeline of accounting is these rules of debits and credits. So the entire accounting, what you can say, that is the gravity, that is the base point. These rules are what are the building blocks of the entire accounting from bottom up. Okay, so if there was no rule, then it would be a haphazard mess, because anybody will be writing down in any way. Like for example, from the business perspective and investors perspective, we saw that the same amount, that is 25,000, in one perspective we thought of it as an asset, whereas in the other perspective it became a liability. That is because, and then depending on the credit debit rules only, we were able to properly say that this transaction is a credit transaction, the other is a debit transaction. The reason why we were able to say it is because of this underlying fabric of rules that run along. If it is not like that, then both transactions, say for example, if the business is also considering the cash as asset means, then the credit and debit would be ulta, okay, in the business transaction side, in the business viewpoint, and it will all become a mess. We will not be able to compare. The transactions won't make any sense. Okay, so it is very important that we make sure each of our books of accounts are maintained properly on the basis of these rules itself. Okay, so whenever an accounting transaction happens, a minimum of at least two accounts are always impacted, because we are following the double entry system of bookkeeping. So against one of those accounts, we will make a debiting entry, and the other account will be given an equal but opposite crediting entry. Okay, and there are no upper limits, like there could be even 3 or 4 accounts or even more involved in a single transaction, but there should definitely be at least two. Okay, two or more accounts are permitted. Okay, and the total of debits and credits, when we total it up for any particular transaction, they must be equal. So this happens when there are many accounts, like there may be one debit account but 3 or 4 credit accounts, or there will be multiple debit accounts but a single credit account. So in the same transaction itself, we will have maybe 3 debit entries or 3 credit entries and only a single debit entry. But even then, when we sum it up, okay, per transaction, the debit and credit should be equal. So we have to understand the golden rules of accounting. So these rules have to be by hearted, no other way out. Okay, these have to be by hearted. But if these rules are becoming more complex to you, if you are finding it difficult to grasp these, for the exam perspective or for stating, okay, if suppose you are going to take finance as your masters, and if an interview question comes, or if a question comes in the question paper in your term and examination, or in general if somebody asks you what are the rules of accounting, the golden rules of accounting, you should be able to what you can say, recollect and say these rules exactly as it is. But if you are finding it difficult to remember all these rules, then I had already earlier uploaded a video on how you can easily identify these accounts and easily apply these debit and credit rules with a single what you can say, with a single secret tip, actually I would say. Do check it out, okay? But it is mandatory that you study these golden rules as it is. But if you're finding it difficult, or if you're finding it confusing to apply these rules, then perhaps you should check out that video. It will become a bit more easy for you, hopefully. Okay, so I'll leave a link to that in this video. Okay, so in the traditional approach, the golden rules of accounting are, there are 3 rules in the traditional approach. Debit what comes in, and credit what goes out. So in the traditional approach, we said, right, there are 3 types of accounts: personal, real, and nominal, right? So if it is a real account, then debit what comes in, credit what goes out. This is for the real account. Now if it is a nominal account, then debit all expenses and credit all incomes and gains. Okay, if it is a nominal account, then all expenses have to be debited and all incomes or gains have to be credited. Now if it is a person's account or a personal account, then the receiver has to be debited, whereas the giver has to be credited. Receiver will be debited but giver will be credited. Okay, so that is the golden rule of accounting in the traditional approach. In the modern approach, we had 5 types of accounts, right? Expenses, revenues, capitals, liabilities, and assets. So for each of these 5 accounts, we have 5 different rules. If it is an expense and it is decreasing, then you should credit it. Increasing means it should be debited. If it is a liability and decreasing, debit. Increasing, credit. If it is an equity, that is capital, and it is decreasing, debit it. Increasing, credit it. Then if it is a revenue account and it is decreasing, debit it. Increasing, credit it. Okay, if it is an asset and it is decreasing, credit it. If it is increasing, debit it. Okay, so this is the golden rules of accounting in the modern approach and the traditional approach. So these 5 rules you have to by heart it. No other way out, you will have to by heart it. It is a bit confusing, I agree, but we have to. Okay, so these were the rules of debit and credit. We will have more videos coming up where we will be applying these rules. Okay, and I had earlier uploaded another video where we have done a lot of exercises in how we can think about the transaction, how we can identify these accounts involved, whether it is increasing or decreasing, and applying of these rules of debit and credit with a very easy to apply formula. Okay, so do check it out. I sincerely suggest you check it out. You might find it very useful in this whole journey. Okay, so if you like the video, if you like our content, consider subscribing to us. If you have more doubts, let me know in the comments. If you need videos on any particular topic, let me know that as well. I'll surely try to include it as soon as possible. So thank you very much and all the best. Bye bye.